Hello, everyone. My name is Jim Bell. I'm the founder and chief investment officer of Bell Investment Advisors. Thank you for joining us for our webinar today that we're calling the Midterm Aftermath. I'm joined today by Corinne Salera Bedford, a certified financial planner and key member of our team here at Bell. She's also a portfolio manager and investment advisor. So thanks for being here with me today, Corinne.
Of course, happy to be here. Thank you.
You should see a question box on your screen, and we invite you to submit questions as we go through our content today. Also, if you're having any technical difficulties, you can put that in the question box as well, or if that doesn't work, our 800 numbers in the right-hand corner there, 800-700-0089. We should be able to help you over the phone. So let's go ahead and get started. Corinne is going to begin by a few comments about the important Federal Reserve meeting and announcement today.
Yes, thank you. Before we launch into the overview and the agenda for our webinar today, we again scheduled our webinar on a date that the Fed has met and made an announcement to raise rates. This happens to be the fourth time that the Federal Reserve has increased rates for the year. The new range Federal Reserve rate is 2.25 to 2.5%. They also lowered expectations for next year in terms of the number of rates they expect, though, as we'll discuss later, they certainly remain and plan to remain data-driven, which we think is very important. But again, thought we would mention that in the onset, since I'm sure many of you received alerts of that fashion and saw that the market unfortunately did not react favorably, and most, if not all, major indices ended down for the day.
Thanks, Corinne. So as you can see on our overview here, we will have more to say about Fed policy on item number 7 when we get there. So please stay tuned. What we're going to cover today, as you can see, is market volatility, divided government, stability of tax and deregulation policies, China slowdown and trade war, corporate earnings, economic strength, Fed policy, and then we'll look forward to next year. So back to Corinne for some commentary on midterm results and markets.
Yes, thank you, Jim. Thought we would begin with a historical perspective of market movements during midterms. What this chart looks at and has assessed is the last 6 midterm cycles, not including this one, and the market and the reaction of both the stock market and the volatility that was experienced before Election Day, 24 weeks before Election Day, and then 24 weeks after Election Day. So that's that vertical axis that you see that marks the election day. So on average, over the last 6 midterm elections, before the election, the market volatility has spiked before the elections and performance has lagged. So you can see here the S&P 500, that's the darker blue line that shows how that index performed before the election. And then the other line, the lighter blue line, that's the volatility index or VIX index. You can see that within these 6 elections, that volatility spiked before election, and then afterwards it actually declined, and we saw a nice rebound in the markets. Unfortunately, this midterm has bucked historical trends where the markets have weakened post-election and volatility has ticked up. That said, focusing on volatility, this recent volatility is not extreme compared to historical standards, although we certainly understand how it might feel that way. So looking back to year 2006, this again tracks that same index that we saw in the prior chart, the volatility index or VIX, and you can see its movement since 2006. And yes, it certainly has ticked up this year, but in comparison to, say, 2008-9, we're actually well below those levels. And 2017 really was the outlier in terms of volatility spectrum. Reiterating that message, we want to look at the daily change in the S&P 500 over the years. This data goes back to 1928. And for example, the first column there, it's showing the S&P 500, how many times it moved more or above 1% or declined by more than 1%. So in 2017, we saw 8 occurrences, plus or minus 1% days. So far in 2018, and this is a bit out of date, this is through November 30th, we saw 54 occurrences. Compared to the average going back to 1928, there were 61. So really this trend, this pattern is consistent where 2017 was an outlier, minimal volatility, 2018 more in line with historical averages, no matter the daily delta that we're assessing. Turn it back over to Jim.
So as I'm sure you know, we now have divided government in Washington, D.C. The Democrats managed to pick up 40 seats in the House, and that's more than enough to have them capture the majority. That may become 41 seats. There's a disputed election in South Carolina, I believe, and if they do run a new election there, it's a good chance the Democrat will win that race. The Republicans did pick up a couple seats in the Senate, so they now have 53 to the Democrat 47. In terms of historical perspective, it's often been the case that the stock market likes divided government. The market in many cases prefers gridlock so that the politicians do no harm. One of the big questions is, will this Democratic House approve the new NAFTA agreement? And that's something we're watching closely. That could be a pretty disruptive event if they decline that or invalidate it. One of the main points we want to make about what we're watching at this point is that the tax and deregulation policies are safe. The president enjoys veto power, so it's extremely unlikely that any of the initiatives that have been passed through, mainly the Tax Cut and Jobs Act, which took effect at the beginning of 2018, that's safe. The executive branch really has the authority over deregulation. The administration has had trouble in the courts, and we see the possibility that the administration may get better at navigating the court system next year. Out of 22 court challenges to deregulation policies, the administration has lost 20 of those. So it's not a very good track record in that regard. Corinne?
Thank you. So we wanted to be sure to address the global slowdown headlines you may have seen. We are in fact in a different environment than we were last year, where we were discussing the synchronized global growth that we were experiencing and how positive that was as an outlook for the economy and the markets. This year is a bit different, although 92% of countries are still, their economies are still growing, and 46% of countries' growth is accelerating. So still positive stats that we're looking at, but again, not as strong as last year. So earlier this year and last year, we were seeing even more solid green on the chart that you see in front of you, which indicates accelerated growth based on the Purchasing Managers Index. For some context, a rating above 50 indicates expansion. A rating less than 50 indicates contraction. Focusing on China, you can see that their most recent rating, that's the lower right-hand corner of the page, is right on the border between expansion and contraction, which is a bit concerning. Another concern in regards to China, their gross domestic product in Q3 slowed to 6.5%, which is the slowest pace we've seen since 2009. But per the chart below, and according to Wells Fargo, China's growth slowdown, at least currently, it cannot be blamed on tariffs yet. Recent trade data shows that the U.S. demand for Chinese goods remains steady in the third quarter. And again, bringing Wells Fargo and others to the conclusion that we cannot blame tariffs yet. But of course, if the U.S. and China aren't able to diffuse trade tensions, we believe tariff-related impacts to both Chinese and U.S. economies will likely be quite meaningful. So I'm going to turn it back over to Jim to talk a bit more about this.
So it's important to understand what tariffs are, and they are a tax on commerce, and when you tax something, you get less of it. So the vast majority of economists agree that tariffs are not a good tool in terms of economic growth. The 90-day truce with the dispute with China is a step in the right direction. That was accomplished in Argentina when President Trump had dinner with President Xi of China. So that's been a positive move. Some challenges or setbacks there was when Trump chose Robert Lighthizer to lead the negotiations. He's a real hardliner. China would have preferred Treasury Secretary Steve Mnuchin to lead that initiative. And finally, on this slide, a day or two later after that agreement with China, Trump ends up calling himself Tariff Man, as if he's a superhero who loves tariffs, and that didn't help. That was stepping on some progress or goodwill that was made in Argentina. Getting back to the situation that China's in, their stock market is in bear market territory. It's down 20% or more, and it's the worst year for the Chinese stock market since 2008. In comparison, that could turn out to be true for the United States as well. This is the worst stock market we've had since the financial crisis. We think that the decline in the stock market is punishing the Trump administration for its pretty extreme trade policies and threats and the language they use. And there's some prospect that should this continue or not improve, that our president and his administration will have a lot of pressure to be more accommodating and change course. Another factor that was a bit of a monkey wrench in the relationship with China was that the United States asked Canada to arrest Meng Wanzhou, CFO of Huawei, one of China's largest tech companies, for alleged sanctions fraud and violation of U.S. export controls. The implications of this arrest initiated by the United States, we don't believe were considered by the White House, especially in the context of this tenuous trade truce between U.S. and China. The reports are that President Trump didn't even know about it, even as he was still talking with President Xi at that dinner. And the underlying assumption here is that the United States can dictate how foreign competitors do business. And of course, that's something that foreign competitors will most likely challenge, and certainly China is. In retaliation, China has arrested 2 Canadians since last week. So there's some back and forth hostility going on in that regard. we believe that the trade negotiations are more important than a confrontation with Huawei at this time. Finally, we believe that what China says and validates is more important than what the U.S. says. And it took a few days after the Argentina meeting to validate what the United States administration was saying about their willingness to cut tariffs on American automobiles coming into China, and that they will buy more soybeans and agricultural products from the United States. They were silent on that for a few days, and that was a bit concerning, but that has changed. I've already kind of covered this to some extent. This happened on December 10th. China did agree and did validate the auto tariffs and the soybean situation. What could be a big change or movement is that China also communicated that it is willing to discuss longstanding complaints about lax intellectual property protections in Canada. In China. So up to this point, they have been unwilling to even acknowledge that the intellectual property theft and lack of protections was an issue. Finally, China laid out an aggressive Made in China 2025 policy with their goal of dominating the world in high tech. And that was going to require some very aggressive moves in terms of trading partners and intellectual property. And they have backed away from that. And that's also a positive move in these negotiations. Corinne?
Turning our attention back to the U.S. and the corporate earnings results within the U.S., they've been very strong. U.S. companies' earnings growth rate is 26% higher than it was a year ago based on the Q3 results. Q1 and 2 were also in that range. For Q4, estimates are coming in double digits, around 13%. So really a solid year across the board in terms of the earnings of large cap companies in the U.S. In comparing 2018 to 2017, we certainly want to keep in mind that the corporate tax cuts provided a dramatic boost to the earnings figures that we just shared with you. For next year, when comparing 2019 to 2018 earnings, that advantage will disappear. Though estimates for 2019 earnings estimates are still solid, but not like what we've seen this year in the mid-20s. Other positives within the U.S., gross domestic product was very solid in all the quarters, Q1 and Q2. Q2 had a GDP of 4.2%, Q3 3.5%, and expectation for Q4 is 2.7%. So I'm sure you've noticed the pattern that we are seeing a deceleration from Q2 to Q4. But our point here is slower growth is still growth. In terms of wages, we are seeing some wage increases, actually the highest wage increase in this decade, highest in a decade rather, at 3.1% for the past year. This has been something we've been looking for a long time, and it's nice to see that it has arrived. The unemployment rate is at a low, historical low, 40-year low, 3.7%. That ties into the job market itself, which we've seen 98 straight months of job growth. So really very solid ground for jobs and that low unemployment rate. Consumer spending remains strong. This is something that Jim and I honed in on our last webinar, that consumers are spending and that retail shops are benefiting from that strong consumer demand. Oil prices also are falling, which again helps the consumers and should fuel that trend where consumers are spending and companies are benefiting. That said, there are, of course, geopolitical and economic risks, a few of which we've already touched on, but these risks have heightened in our perspective. Focusing again on the U.S. economy, we are seeing some sluggish housing and auto maker numbers coming out. So this is something to pay attention to. Tends to be a leading indicator for things to come. As Jim focused on a few slides ago, there's of course uncertainty around trade policy. We do believe that this is fueling anxiety in all corners of the global economy and certainly adding to the market volatility that we've experienced so far this year. Back to the job situation, we do have a very low unemployment rate, but there is a scarcity of workers with more jobs open than those seeking work. That's a risk and a concern for us. And finally, Brexit, another headline I'm sure you've seen. The timeline and path forward still rather unknown, and that of course creates a risk for the UK, EU, and perhaps globally. More on Fed policy. I'll turn it back to Jim.
Thanks. So we just changed this slide this afternoon. Before the Fed announcement today, the Fed funds rate regulating overnight loans between banks was in the range of 2 to 2.25. Now with the quarter point increase, that range has increased to 2.25 to 2.5%. So this is the ninth increase since December of 2015. As Corinne mentioned, the market did not respond in any way favorably to this, at least in the short term. One way to look at it is that with Chairman Powell's comments that they might do 2 more rate increases next year to get the Fed funds rate to what they consider to be neutral, neither stimulating or restricting the economy. So in that context, they've done 9 increases. There may be 2 more, and that would be the end of it. So we're certainly almost done with this cycle of trying to normalize rates and cut the addiction of the U.S. stock market and the global stock markets, the addiction to cheap money and easy liquidity. Another comment that Chairman Powell underlined is that they are not going to be on a set path to raise rates every quarter. They are going to study the economic data, and as I mentioned, they're focused on a neutral rate. Certainly what the market has been worried about in investors is that the Fed will go too far too fast and begin to restrict the economy and really hamper growth. Another way to think about the Fed is that they are in a wait and see mode to study data before they do more increases. The data could change next year and we could see different results. But their predictable path of rate increases has definitely faded away.
Thank you, Jim. As Jim mentioned, there's this fear that the Fed will move too quickly and hurt the economy and markets. For another historical perspective, this compares the current rate hike cycle against 4 others. The red line is the cycle we are currently in with some of Goldman Sachs' forecasts. Those are the dotted lines. The solid line is what rate hikes have already been implemented, not including today's announcement, of course. But again, the point that we're trying to make is that the Fed has been very data-driven, slow, much more gradual in their path of increasing rates than prior cycles. And we think that is a positive, and the fact that they are committed to continuing this process and adjust the path forward given the economic data, we think is important, and hopefully that fear will dampen going forward. Focusing on the yield curve, just recently parts of the yield curve have inverted. What does this mean, and why does it matter is the question hopefully we can answer here today. So in a normal rate environment, the longer term issues focusing on, say, 10-year, those yields should theoretically be higher than the 2, 3, or 5-year yields. The part of the curve that inverted is the 2 to 5 and the 3 to 5 year yield or curve, which means that the 2 and 3 year yields are actually higher than the 5-year yield. Why does that matter? This has been a very predictive indicator, meaning when the yield curve inverts, that tends to predict a recession. And so now dive into these bullet points. So yield curve inversion can reflect expectations of slowing growth, but flattening yield curve is very common during late rate hiking cycles, which is where we are today. If you compared the last chart to the other cycles, we are further along than other cycles. And this time around, we do believe that the shape of the curve has been distorted by central bank asset purchases around the world, making it a less trustworthy predictor of recession. Another point, the curve can stay flat for a long time. It has been flat for quite some time, actually. And even upon inverting, a recession can take a long time to arrive, months to years. So just because we have seen parts of the yield curve invert does not mean, it doesn't mean we're going to enter recession next quarter by any means. So to summarize, while growth is likely to slow next year, we believe that our near-term odds of recession remain quite low based on the yield curve inversion.
So to draw conclusions from what we've presented here, we wanted to point out that since 1945, there have been 18 midterm elections, and the year following each of those 18 midterm elections has been positive for the S&P 500, an 18-year winning streak in terms of the market post midterm elections. No down years, and the average gain for that year following the midterms is 19.13% on the S&P 500. So we will see if 2019 breaks that winning streak. As Corinne pointed out, market volatility is not extreme compared to every year since 2006. The tax cuts, which have been so stimulative to the U.S. market, will remain safe. And China is slowing, but still growing at an envious rate. The last read was 6.5% GDP growth compared to what Corinne talked about for the fourth quarter, which may come in at 2.7%.
Exactly. Mm-hmm.
So another point here is that China is showing some flexibility and some willingness to make peace in this dispute with the Trump administration, and it has cut some of their tariffs on our goods coming into China, and they are signaling that they're going to buy more agricultural crops from the United States. Corinne also mentioned that in terms of corporate earnings growth, it's been as high as 26% in 2018, and and it's on trend to close out Q4 in double digits. Market risks are evident, and investor sentiment has certainly turned a bit negative. And that's something we're watching closely, and the sentimental attitudes can turn on a dime. So that's what we'll be watching for. The Fed is showing flexibility on the rate increases, Near-term odds of a recession remain low, and the outlook for 2019 is more growth. Slower growth, but more growth. And finally, we want to emphasize, as a financial planning organization, the most effective personal portfolios and their strategies and asset allocation are directed by a comprehensive financial plan. So that's our content for this webinar. If you haven't submitted any questions, we invite you to do that now. We'll make sure that one of our lead advisors gets back to you with a response to that. This webinar has been recorded, and it will be placed in our library on our website probably in about a week's time. We also invite you to look at the inventory here of past recordings that are available on our website. Lots of ways to stay in touch with us. We always welcome your calls and messages, and we certainly invite you to review and learn from the content that we produce on a regular basis. I guess going back a bit, Corinne and I will be joining you again on January 30th after we've had a month to digest how the market is moving in 2019. So thank you very much for joining us. We wish you happy holidays and happy new year, and we look forward to interacting with you in January. Thank you so much.
Thank you.